Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. You all are very well aware of the technology sector and growth style. Equity styles have sold off tremendously this year. In fact, the NASDAQ 100 is in a bear market. You know, that sell-off could result in some financial professionals rethinking the way they view investing in very popular trends or themes. Well, I am very excited about today's episode. As I have on the perfect guest to address the current sell-off. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Joy Yang. Joy is the head of index product management and marketing at MarketVector Indexes. Joy, thank you so much for coming on the show. It's a complete honor to have you on. Can you please tell us a little bit more about yourself and Market Vector Indexes?
Well, thank you, Ryan. It's certainly an exciting time to be on your show. So, as you mentioned, my title is Head of Product Management and Marketing at Market Vector Indexes, but that doesn't nearly describe all the things we do at a very fast-paced environment of indexing innovation. So, we're probably one of the largest index company that you've never heard of because we have over 50 billion in assets linked
Wow.
across equity, bonds, and digital assets. And we're just not indexing your traditional regional or sector exposures. We're really trying to help our clients target very specific, precise exposures, and those are around indexing innovation, such as artificial intelligence and the high-tech growth stocks, or indexing geopolitical risks because we're trying to help you manage your risks, and also indexing kind of these nascent asset classes like digital assets. So our focus isn't just about delivering you the index or the data, but it's also really about providing kind of the insight and the education that goes along with how to understand these index exposures.
Interesting, Joy. So, you know, the ETF space in index, it's evolved greatly. Now it's like all about active ETFs. How does that impact a business like Market Vector, where I'm assuming before you're creating indexes for more rules-based ETFs? Are you still seeing a lot of demand for obviously for different indexes to match more rules-based ETFs?
Yes, absolutely. And I think, I was involved with a book called Active Indexing because, when I see the line between passive and active as this very, very long gray line because, you're trying to really define rules using discretionary decisions. So many index products are actually active because you had to decide up front,
Yeah.
how to manage these exposures or what exposures you want to target. Like, for example, artificial intelligence. What does that even mean and how do you define it? It's not a sector, it's not an
Yeah.
industry. So it really requires kind of this human decision to really understand what the definition of artificial intelligence is. And on the other spectrum, where you have all these active managers, you sometimes want to make sure that alpha signal is repeatable, that you can, consistently capture it, and that it works in different scenarios. So you design rules that try to model some kind of maybe proprietary knowledge, but you want to be able to back test it. So, in these instances, you're using a rule-based approach to capture a very, a fundamental approach, but you're maybe packaging it in a more low-cost, effective way in an ETF wrapper. So I think, the ETF is a great structure for capturing both passive and active strategies.
Joy, that's fantastic. I feel as if we could have a whole conversation just on that. We're here to talk about the market sell-off. So, but that's really interesting you brought that up. When I aged myself, when I started in the industry over 20 years ago, it was like you were either a passive investor or an active investor, right? Now I think it's like, let's throw that out the window. You can be both, right? It should be inclusive, not exclusive. And I haven't heard that thought of, even if you're a rules base, it's still active in the sense that you're creating, it's not like the spiders or VO or something like that where, it's very cut and dry, those active or even rules-based ETFs can still be active. So it's great commentary there. You know, the Nasdaq 100 is in a bear market from its recent highs, and it's down now 15% year to date or so. Meanwhile, the Meg 7s are down over 25%. What does a big sell-off in the mega tech or Meg 7 technology names, which have driven market performance over the past couple of years, mean for financial advisors as they try to build investment portfolios for their clients?
I think the big takeaway that we have at the moment is the importance of communication and education. I love your tagline around insightful, actionable insights, because sometimes the best action is actually patience or staying calm. And to do that, you need information, insight, knowledge. And I think right now, investors really have to be careful about understanding what's noise and what's real information they can act on. And, we've seen a lot of investors right now overreacting or even reacting on rumors, and you don't find that out until maybe it's too late and you've, acted on a bad investment decision. So, it's uncertainty is extremely high right now. So I don't know, it may take days, weeks, months for us to get clarity. So I think right now the best course of action is to understand what is your long-term goals, because they can help shape your short-term opportunities. But also, you need to be able to differentiate these short-term shocks from these long-term shifts, because ultimately we'll refocus back on fundamentals. They may have shifted, but we will kind of adjust to fundamental valuation. And I think the best course of action is also to always have perspective. This is the nature of markets. They are volatile. You're not going to get reward without taking on risks.
Yeah.
And, you have to stay invested, because if you think about what happened during the pandemic, where we saw a 35% crash, over the next year, we had a 75% return. And we don't have to go back too far to a bear market. The last bear market was only in 2022. And that was a, 25% crash. And then we had two back-to-back returns of over 20%. So, you have to be able to understand how much risk you can tolerate, and then understand, the nature of risk is that markets will go up, but it doesn't go up in a straight line.
Yeah. Yeah, it's not linear, is it, Troy? Um, you made a very good point about just education. You brought it up at the opening about market vector and education and, research. It's so important. And, you know, investing is very behavioral, like you said, and emotional. And sometimes I feel as if especially the older, and not even that old. The Great Financial Crisis really wasn't that long ago. And the people that lived through that, maybe they're a little better investor in terms of you realize the importance of staying invested when you've kind of gone through some of these crises in the past. Whereas the younger investors, maybe there's a little uncertainty and, who haven't lived through something like this.
Yeah, I think it works both ways, because I think, I lived through the great financial crisis.
Yeah.
I got burnt in it. makes me a little bit cautious, but at the same time, you want people to take risk. You want them to be optimistic about the future. We want America to be exceptional, but I think you have to also really kind of always not be too blinded by, risk does change. AI is a great story, but it's going to evolve and mutate, and you have to constantly adjust how you see that story. You have to constantly adjust and reprice, given that you have new information and that you have a better understanding of risk, even to understand, how much risk you yourself can tolerate. Because if you can't sleep at night, you probably are better not off not taking that much risk.
Yeah, you're exact. I talk about that often. Being able to have your clients sleep at night is so important. And you brought up about risk. You gotta, for the investor, for our financial advisor investor clients, understand what their biggest risk is. We often talk at Zephyr, standard deviation and volatility is important, but to me, like upside volatility or upside deviation, I'll take all the upside deviation you want to give me. It's that downside deviation that I don't want. And I feel as if people have to understand what's your biggest risk. Is it losing your money or is it just deviation or sequence risk? What is that? You got to understand it so then you can hedge or diversify that away.
Yeah, and this is a great test of really, going through that exercise because we're getting tested in real time. And,
Yeah.
and I think your own personal reference point will change also as you, age, as your circumstances change, that will change, how much of, risk you can tolerate also. So this is constantly something we have to reevaluate.
So let's talk about this sell-off and the risk, and for financial advisors. Do you think investors got a little too confident about the future prospects of technology stocks? You mentioned AI, some of these really popular themes that look like they were going to the moon, right? Particularly the mega tech stocks after years of great performance. Do you think this correction maybe was a little needed to reset expectations, get people back grounded? That, like you said, risk is still there, it's not going away, despite how painful it's been.
I mean, I think we can confidently say, yes, AI is going to be revolutionary. It's going to change the way we do things. It's structural, it's pervasive, just from, what little we've seen of its progress so far. But I think the problem is, who will those winners be and what does that growth projection look like? I don't think anybody has the confidence in understanding what the future looks like. And that's also the nature of innovation. It is disruptive, but that's disruptive in a good way because it will create really exciting new opportunities
Mhm.
and companies to invest in. So I think, it's good that people are getting a little bit grounded in reality, in understanding they can't predict the future, but there's great opportunities out there, and it's trying to understand how to best capture that without being too concentrated or how to manage the risks of maybe something not exactly working out the way you thought it would.
Yeah, and it goes back to diversification, right? For years, and you know, people wondered why am I maybe holding bonds when I'm getting 2% yield, and or international when US is outperforming. Diversification matters, right? And this is a great point. Like you just said, you might want to be exposed to AI, but not overly concentrated in it for times like this.
Yeah, diversification definitely matters, but sometimes, as we've seen the past, few days, we're seeing sell-offs in price in both equities and bonds. So I think, be kind of really be wide about, where you're looking for diversification. So it's not just America, it's going to be international markets. It's not just about equities and bonds, look at, digital asset, look at gold, look at really, alternative assets, because, when you have such a significant shock like we, have been experiencing, it can have very significant systemic impact.
Mhm.
But, it's all relative. Some will survive better than others.
Yeah, and it goes back to the open what you mentioned about market vector and all the different maybe niche ETFs and indexes out there now. It's helping create more diversification, right? For financial advisors, giving them more products, maybe to diversify. Because a few years ago, it was a lot harder to get into private credit, private equity, um, even Bitcoin. Right now, Bitcoin has spot ETFs, so it just makes it much easier to enhance diversification, I think. Um,
And maybe the other point to highlight also, ETFs made it a lot easier, and especially companies like us that are designing these more esoteric indexes
Mhm.
are making it a lot, also a lot better opportunities to capture these opportunities. But I think it's critically important that, you know, just because you can see what you're holding, you don't understand always what you're holding. So that information and the knowledge and the education is still super important to help investors understand, how these indexes will, or ETFs will, will react in different scenarios.
that is spot on, Joy. I often talk about you really have to understand what you're investing in and know, especially for a financial advisor, if they're going to go and sell an ETF or something to their client, they got to make sure they understand it so their clients can. There's some really unique ETFs out there, triple leverage, inverse. Um, I don't really understand some of them. So it's education, like you said, because during times when markets are up 20% a year, those products, some of those products look really great, but it takes a sell off like this to be like, okay, what is this thing? Um, so very good point. And we talk a lot about is make sure you understand what you're investing in. Do you think this sell off, the sell off in AI and some of these growth names, the Mag Sevens, they started way up before the macro uncertainty really hit over the past couple of weeks. Do you think the sell-off in part was been due to repricing of that AI growth technology trade since it started, earlier this year, maybe even the end of 2024?
Yeah, so I mean, it is interesting. I think there was a start of sell-off that started much earlier, and that is a repricing of the AI story, because the AI is going to evolve. It's constantly changing. We're getting new information, and it's moving from these enablers to adopters to facilitators, and we're seeing competition come out from everywhere. But I think what we're seeing now is more than an AI story. This is definitely a pervasive repricing of all assets, because the risk premium just went up. So, across asset classes, price has gone down. And that's important to understand, because, we have to also now differentiate, what's a short-term shock story and when will that unwind versus, have we structurally shifted to a new kind of paradigm, and, how should we think about repricing, not just for the next week, but for the next year. So I think all of that it's going to be complicated. And I think, we, still are trying to process all the information to, have it, but repricing is continuous.
Yeah, very good point. And just with the macro uncertainty, it probably makes it repricing so much more difficult and trying to find, where the bottom is, where is the intrinsic value of some of these investments. So, like I say, it may take a while to find
Will
out.
take a while, and people maybe have short-term liquidity needs that are not related to their long-term outlook. So we're seeing all of these dynamics and trying to make sense of it. But it may take a while, and not to read, one story into like different drivers.
hmm hmm So, repricing and risk, when markets are up, like is it 20% and doing really well, and I hate to say it, but it's easy. And then all of a sudden something like this happens. Is it time for maybe financial advisors to reevaluate the risks of some of these very popular trends, whether it's trends from years ago, like the dot-com bubble, now you have AI, megatech, crypto. When you have a big correction like this, should they reevaluate these risks? We've talked a lot about risks and repricing. Is this a good time to do it?
So, the short answer is yes, you should always be reevaluating your risk, whether it's going down or up. Um, but I think the long answer is it's yes, but because this is the nature of risk. You're not going to get reward without risk. So that's a foundational investment principle. So then the next thing is to understand, how you think about risk because timing is difficult. I think buying high, selling low is not a good investment strategy, right?
Yeah.
So I think you have to understand that you're probably not going to be able to time it right. So how can you manage and control like how you think about risk, or are there ways? And we talked about diversification, and I think that's critical. But it's important to know it's not just diversifying out of one stock or one sector or one country. It's diversifying out of the asset class that you're focused on. So I think it's to look as broad as possible, and to really be able to, hedge some of the worst case outcomes, but also think about, that all of these are growth opportunities, and you don't want to miss out on a growth opportunity by over, protecting yourself or getting out of the market completely.
Yeah, you're exactly correct. It's important to diversify, understand those risks, and that's about really understanding your client as a financial advisor, really trying to figure out what are their biggest risks to achieving their goals and trying to help them hedge or diversify that. You talked about understanding what you're investing in. Bitcoin's really popular and I never really understand Bitcoin. Be completely honest, when it first came out, it took a while, and so I didn't feel comfortable investing in it. It didn't have, the fundamentals that I'm used to when I evaluate a investment. So I never felt comfortable doing it. Now it feels as I missed the boat. But that just depends on how you look at it. you know, Now Bitcoin, there's ETFs. I think, gosh, there's 13, is it, Joy? 14 Bitcoin ETFs in the past year, more. Um, how does that impact the crypto space now that Bitcoin ETFs are popular out there? Is it, making it more mainstream and but also maybe adding some volatility to it?
Yeah, so that's a great and complicated question.
Another episode for that one too.
That's
Lining up
another.
a lot of episodes here, Joy.
And I think we're all, this is a really nascent asset class, and people tend to lump all crypto assets together. And we know, like within equities, Amazon is not the same as Alibaba, is not the same as GameStop, and same too in crypto asset. Bitcoin is not the same as Dogecoin or Ethereum. So I think, we start at MarketVector, we start by classifying crypto assets into groups like sectors because they can help us understand the differences in kind of the risk and reward dynamics for the different use cases or the different projects that these technologies are trying to capture. And Bitcoin is unique because it is, really more of a store of value, and we often talk about it as digital gold. So it's really much simpler to understand, and maybe that's why spot ETFs started first with Bitcoin because it's a very simple story. We understand gold, we understand,
Mhm.
what having a limited supply is, we understand what having trust in a asset class that isn't influenced by fiscal or monetary policy, which we're really seeing relevant these days. But we go back to this is still a growing asset class. It
Mhm.
started with these Bitcoin maximalists who were holding it for a philosophical reason. And then the volatility attracted speculators who were holding it for price, opportunities. And, when we got the regulatory clarity for Bitcoin to be wrapped in an ETF structure and the infrastructure around institutional, like rigorous
Yeah.
platforms, then it was able to attract a much wider audience who, may be holding it for long-term buy and hold opportunities, maybe holding it for speculation, but you're seeing kind of this mix of investors come in, and that's really kind of changing the characteristics. So going back to kind of the first principles of understanding the investment case for Bitcoin, we expect that this will move more like a digital gold store of value. So it does, potentially have a strong case in your portfolio. It's not a core position, just like you wouldn't hold gold at 100%, but it could offer good diversification benefits, just like we're seeing, right now it's starting to stabilize, gold, like everything started to sell off, but we're starting to see as we're getting more clarity, some of the different asset classes kind of show their really long-term valuation case.
Yeah, and as like you said, as things age and get more mature, maybe not me, as I get more mature, things stabilize a little bit, right? Maybe you're seeing that with crypto and Bitcoin, reducing some volatility. It's interesting you brought up, you know, the diversification benefits and including in portfolios. And in our prep call, Joy, you mentioned some studies that you guys have done at MarketVector. We've done some at Zephyr also when creating an efficient frontier, optimized portfolios, and including Bitcoin um, within those assets, I was shocked. And this was what really opened my eyes a few years ago is that, and it's a lot because of the correlations, every portfolio along that efficient frontier had some type of allocation to Bitcoin. It could have been very small, but that really opened my eyes to the benefits of Bitcoin in a portfolio.
Yeah, we happen to have, a long history of indexing Bitcoin, indexing other crypto assets. So we get to test that, in depth in this back tested environment. And we can see that, the nature of Bitcoin is stabilizing, and we can test it in, as you mentioned, in different scenarios. So we can find that optimal point and the efficient frontier for, what we're testing with all the data we have is around 5%. It makes sense because, people, the markets really aggregate people's risk and reward outlook. And we're rational people. We're not going to just buy things without considering the risk.
Yeah.
So, there is, definitely opportunities to put Bitcoin and other crypto assets into your
Mhm.
portfolio. But as you said, in kind of these small measured risk appropriate amounts.
Yep. Yep. Fantastic. You know, real quickly, wrap it back, bring it back to ETFs. We've seen volatility. ETFs have just grown tremendously over the years, and started by talking about the little niche ETFs out there. Do you think, though, the popularity and the liquidity of ETFs have added to the volatility of some of these disruptive investments that we've talked about, that it's easier to get in and out of? People maybe are day trading them instead of buy and hold. Do you think it's added some volatility?
Well, it's interesting because I don't know if a lot of people know that the idea or the inception of an ETF structure really came out of the 1987 market crash. And as people started to review what happened, they recognized there is this strong need to have like this very efficient way of transacting in a basket of securities because that can help kind of mute the volatility and provide ways to get stability back into the market. So that was the initiation of the concept. of, ETFs. But I guess since then we've like multiplied that with leveraged ETFs and really all these like illiquid, wrapping up really illiquid assets. And, so it's a double-edged sword to be able to wrap something up and provide easy access, because easy access without understanding what you're investing in means that when you're tested, that's the first thing to people will sell out of, and that could create volatility. So, I think it's been great because it brought down costs. It provided access to people who normally wouldn't have access to some of these strategies. But yes, it may have created, volatility by providing access to strategies people would not normally have. So again, we go back to this point about understanding, what it is you're invested in. But I still think overall the ETF structure was so beneficial, and it really helps reduce overall market volatility, because we have seen during a lot of these crashes that the volume in ETFs have spiked without kind of the, kind of, market fear or dynamics we've seen in previous crashes.
Yeah, that's great information. And it goes back to, kind of doing a full circle here. What you mentioned a few times is you need some risk, but it's like a double-edged sword, right? You want returns, but risk are going to come along with it. You just got to understand balancing it, right? ETFs are great. I agree. Um, and you take the benefits with the, maybe the added risk, but there's no free lunches, Joy. There's no free lunches. So.
But know what it is you're ordering and
Yeah,
eating.
exactly. Joy, thank you so much for coming on the show and sharing such great insight. I learned a lot. I'm sure our audience will too. It was a lot of fun. Where can our audience get more information about market vector indexes?
Okay, it's marketvectorindexes.com. Marketvector.com is our website. And you can find us on LinkedIn, on Twitter. We do vlogs, and white papers all the time.
Yeah, you guys do some fantastic research and put out some great information. Like you said at the beginning, some education before our conversation. I went to your website to learn some great stuff there. So good job. Really enjoyed it. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your day.